Hello, folks. Welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoteric Capital Markets. Today, what I want to talk about is a contrary investment idea. Now, you may think that my cornbread's not quite cooked all the way in the middle on this idea, right? It is contrary. But what I want to talk to you today about is inflation, right? I want to talk to you about TIPS, Treasury Inflation Protected Securities. All right, so let's start off. These are Treasury bonds. So what I'm proposing you think about is if you take some of your existing bond holdings, some of your treasuries, existing treasuries, and just replace those with TIPS. All right, so let's talk that through here before we get started. Since they are treasury bonds, right, even though they're inflation protected, they are treasury bonds. And so the biggest risk component to these bonds, to these TIPS, is the interest rate risk. Changes in rates are the biggest risk. Right, so if rates go up, the value of these bonds go down. Now, let's talk that through here real quick. We got a Fed chairman that said for the next 2 years, he's not going to raise rates, right? So at least short-term interest rates, we don't have to worry about those going up and losing money on our TIPS. All right, that's a good thing. So the Fed chairman says 2 years, the market's actually pricing over 3 years now, in which the Fed's not going to do anything. You say, oh, that's interesting enough, fat guy, but that's only the short rate. What about the rest of the curve? These are longer-term bonds. We got to worry about longer term interest rates, not the short Fed funds rate. All right, that's true. That's true. Well, longer term rates, the next trick that the Fed's got up its sleeve is something called yield curve control. You're going to hear a lot about this in the next 6 months. Yield curve control. And it works like this, ladies and gentlemen. With quantitative easing, we are able to keep short term rates low, very low. Right? We do that with quantitative easing. It's called repressing interest rates, right? Or keeping short-term interest rates artificially low. So the idea is, if that's a good idea, hell, why not take all interest rates and make them low? That's yield curve control. So we're taking quantitative easing, taking the very short rate, and now we're going to do the same thing to all interest rates, right? The entire yield curve. That's the idea. So that'll serve two functions. It'll keep all rates lower, if it's implemented, which it looks like it's going to be. And by the way, the market's already starting to price it to be implemented, right? But one, it will keep interest rates low. Yield curve control will keep interest rates low, and it will repress volatility because the Fed becomes a marginal price setter. So the way it works is they determine where they want the 5-year interest rate to be, and they buy and sell bonds around this. You're laughing. Hell no, I'm not making this shit up. This is the world we're living in right now. And this is what's coming at us. It's called yield curve control. But for our purposes, again, if we moved into these TIPS, we'd be worried about the interest rates going up. Well, there's less risk of that, right? We have the tailwind of this yield curve control in our back. As I said, these TIPS, the main source of risk is the interest rate risk, which we just discussed. Now let's talk about inflation risk. Inflation is low right now, and there's no signs of inflation on the horizon. And that is true. That is true. I'm going to show you some evidence of that very quickly. My point is, I think myopia is setting in, right? I think too many people have gotten off to on one side of the boat here, right? The boat's teetering because all the fat guys like me are on one side of the boat, and everybody's thinking, we're never going to have inflation ever again. I'm going to call bullshit on that one, folks. I'm going to call bullshit. All right, and I'll give you a very convincing argument as to why that is. But let's jump in the charts here first. Now, the first thing we want to document is that inflation is low and it's expected to stay low. Okay, so here we have the global inflation surprise index. All right, so the way this works is when it's below zero, inflation's disappointing. And you can see inflation has been a huge disappointment. All right, much like I was to my parents, inflation is a huge disappointment right now. All right, and you can see we're near the lowest levels of the last 20 years, right? That's how much inflation is disappointing right now. Again, this is global, not just the U.S., but I just wanted to point this out, that inflation not only has evaporated in the U.S., it's evaporated globally, right? That's another reason for this mindset that nobody has inflation, we're never going to have it again, blah, blah, blah. Let's go back to the chart. The second chart I want to show you here is U.S. headline inflation, right? So what we're looking at here is the CPI basket. It's the consumption basket for the U.S. And you can see the most recent reading shows that it's almost zero, 10 basis points, right? Is it the lowest ever? No, but it's not far from it. It's not far from it. It could go lower, and it wouldn't surprise me if it continues to go lower. But I don't think, I just don't think this thing's going to last forever. That's what the market's thinking. What? How's that, fat man? Well, we can look at what the market's pricing for inflation 5 years from now. It's called the break-even rate. That's what we see on this chart. The break-even rate 5 years from now, as of July 8th, is 1.25%. Again, the target is 2% inflation. The market sees no chance of generating meaningful inflation for the next 5 years. Hell, that's nothing. I can show you a 10-year chart, and it's not much different than this. The market isn't expecting any inflation for a long, long time. Again, this number is not the lowest in history, but it's not that far from it. Okay, so we just documented there's no inflation today in the U.S. and outside of the U.S., right? Inflation is disappointing everywhere. The market's not expecting any inflation for the next 5 to 10 years, nothing meaningful. So you're saying to yourself, hey, fat man, where do you think this inflation is going to come from? Why do you think so many people got it wrong? Well, we've got the printing machine running full blast right now, folks. I'm going to show you something here. I'm going to get technical for just 30 seconds on you. We're looking at dollars in the marketplace, right? It's called money supply. There's two measures of money supply, something called M1 and M2. But again, these are very simple concepts. It's the number of dollars floating in the system. M1 is just cash, immediate cash, right? Cash available today. So cash, checking deposits, and so forth, right? Cash that you can generate very quickly. M2 is a broader definition. It includes M1, plus it includes what's called near money. Anything you can turn into money in the next 30 days. All right, let's take a look at the growth rate. All right, so again, the growth rate of dollars floating in the system. This orange line here, we're growing at 23%. That's twice as high as anything we've seen in the last 30 years. 23% on M2, again, the broader measure of cash in the economy. M1 is growing up here at 33.5%. Are you kidding me? Look at the stimulus we got in 2008. They call this a Great Recession. Hell, great what? This is ridiculous compared to the amount of money we're printing today. Right? Now, this is a stimulus package. And by the way, when we look at these measures of money supply in other countries, right, everybody's had a stimulus program. Nobody has had money supply exploding like we did, or like we do today. Their packages so far just pale so far in comparison to us. All right, so we're reaping the benefits of that today. We got money floating into this system like we've never seen before. Again, on the order of twice the rate we've ever seen before. All right, so what's that doing? Well, right now, we got all that money going into the system, and it's got to go somewhere. Well, where's it going? We know we're getting asset price inflation, right? Asset prices are being driven up in the equity markets in particular. All right, but I think eventually we are going to get inflation in the general economy. Not only in the stock market, but in the general economy. We are just printing too damn much money for them not to show up and not to generate some inflation at some point. That's my belief. That's the card I have up my sleeve. No, there's no inflation today. No, the market's not expecting any. But can we really print this much money and not generate some inflation eventually? I just think, it's almost like we're getting a free pass here because everybody thinks there's no inflation and there's never going to be inflation again. So given that backdrop, it's kind of a easy time to take the contrarian approach and say, well, there might be inflation, especially since we're cranking money out like we've never cranked before. All right, so that's arguments in favor of this idea. Now, what's the arguments against it? Well, it's something called the velocity of money here. This is the last chart I'm going to bore you with today. The velocity of money, again, I don't want to get technical here, but the velocity of money just measures how frequently a dollar bill changes hands to generate growth. All right, so think about this. You go out and you buy a hamburger, right? And the guy that owns a hamburger joint, he goes out and he buys an iPad. And the iPad guy goes out and he buys a beer, whatever. That same dollar just keeps switching hands over and over again. That's the velocity of money. It's a turnover in money to generate economic growth. All right. Now, let's go back and take a look. The velocity of money is low, very low. In fact, again, the lowest ever. Now, why is that important? Why is the fat guy bothering you with that? This box here, folks, it's almost impossible that we can have any sustainable inflation unless this damn thing starts going north. All right. And there's no signs of that whatsoever. So as long as this velocity of money keeps falling, and again, look at this chart. This bad boy has been falling for a long, long time here. All right. So as long as this thing keeps falling, my idea is a bad idea, right? It's not the first bad idea I had, but it probably won't be the last one either. But the velocity of money can't fall forever, right? It can't fall forever. So while we're printing money like we've never seen before, I'm just thinking it's worth considering some of these inflation bonds, right? Considering the possibility that at some point we will generate some inflation in the economy. And if we do, inflation is generally not good for the stock market. So you would at least have a bit of a hedge if you had that in place. All right. So that's the idea I wanted to leave you with today. I'm Don Rich, and you've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.